All right, so let's go over the first part of the problem that we have. In this problem, we had that we needed to prepare all journal entries and T accounts completely for January 2013. And this is the first thing that we're going to do here. So you should have received from me the service business accounting exercise, as well as the ledger or answer sheet that has the transactions, how they happened. So the first thing that I will do is I would write down the assets, liability, debits, and credit on the top, so I have some sort of information into if it's a debit or credit, or how is it that it increases or decreases in case I get stuck in some exercise. So the first thing is pay $300 to Hostos Community College to receive child care provided license in 1/3/2013. So in 1/3/2013 we have training expense, then cash, debit, and credit. Training expense is debited because it's negative, and the kind of expense reduces capital, thus it's a debit. And we pay in cash, so the credit decreases cash. Second one, rented an apartment for the business location on January 7, 2013, and we made a cash payment of 3 months of rent in advance and 2 months of security deposits, a total of $5,000. So it is a given that we spent $5,000 in cash, and just like the one before, we had to reduce cash, debit cash. And this might be a little bit where we could get stuck on. There was a $2,000 deposit where we could make it this still has value, so it is an asset for us. And then we have prepaid rent. That is also an asset because we have not spent the money on the rent that we have paid, so it's $3,000. I made this in a different color because this might become an adjustment later. The reason why it's going to become an adjustment is because this prepaid rent here is actually for the month of January, February, and March. But in the month of January, we're going to use up that rent money, so we have to account for that later on when we do the adjustments. On number 3, we have purchased 2 fire extinguishers for $120 in cash. So we have the date, we have office supplies, 120 debit because it's gonna increase in office supply, and we have cash, we pay it in cash, so we're gonna credit that. Don't forget to put the description in the bottom. Number 4, received invoice from daycare marketers for flyers ordered on January 15th for $200. We did not make any payments. This is just an invoice, and we have not exchanged any cash. So the accounts that will be affected is marketing expense, $200. Again, usually when it's an expense, here's a debit because an expense reduces capital. And then we have cash, accounts payable, $200. That increases because we increases a debt that we have, so accounts payable a liability, and it increases a credit. Then we have on number 5 that we paid the promoter, marked the promoter, $400 to distribute the flyers throughout the neighborhood on January 16. So on January 16, we paid cash, so that's a credit. And we have a marketing expense to pay Mark for the handing out the flyers, which is a debit. It's again expense, debit. Number 6, we purchased $3,000 worth of baby furniture in IKEA on credit on January 18. The expected life of the furniture is about 5 years. So we put in furniture $3,000. This is an asset, and notes payable because we didn't use our cash of $3,000. Again, keep in mind in this situation where that this furniture has a life expectancy of about 5 years, so we should be able to use depreciation later on when we do adjustments to be able to account for that. Then we have number 7. We have that we received payment from John Smith, $300 for daycare services provided on January 22nd, 2013. This is our first client, and In this case, we receive cash, 300, cash, debit, and then this is revenue. So we just let's call it child services revenue, 300. And again, it's a revenue increases capital, so it's often a credit. Number 8, bill Jane Research for daycare services provided in the month of January for the total of $300 on January 23rd, 2013. So January 23rd, we sent in a bill to Jane Richards for $300, and we received from Jane Research revenue with $300. No cash has been exchanged. However, this is money that we already own because it's a service that we already provided. On the 25th, Jane paid $200 of that money, and then she promised to pay the rest the first week of February. In this case, we're going to reduce accounts receivable by $200. So reduce is a credit, and we're going to debit cash because we had an addition in cash. Number 9, Rosie paid Alba, a part-time care provider, $400 as salary for the month of January on January 28th. So 128, salaries expense, $400, again expense, usually a debit, reduces cash. And then we put cash, $400, again credit, so it reduces cash. Reduces capital, reduces cash, I do apologize. And number 10, Rosie took $500 for the business as a drawing for the month of January on 1/30th. Let's just fix this, 1/30th, and it was again the Rosie drawing. It was a debit. When you take money out of your capital, you debit. And then we have a cash decrease of $500. Okay, so this is what we have here. And what we're going to do next is we're going to work on our T accounts. So any account that was affected here must be affected on the ledger. These are the ledger accounts here. So the first thing that we need to notice is that before when you do any ledger account or any T account, the first thing you're going to do is you're going to put the title of the account on the top. You're going to put the date debit, date credit here, and also be aware of that if it's an asset, the beginning balance is always going to be on the debit side. If it's a liability or capital, the beginning balance is going to be on the credit side. So in this case, cash, if we take a look at the original exercise, cash had a beginning balance of $20,000, 10 from the business, 10 for the local credit union. So we have $20,000 in cash here, and then we have that capital has a beginning balance of $10,000, which was Rosie's beginning investments, and we have a beginning balance of $10,000 from the loan that we took from the credit union. After we have that, we could go ahead and take a look at how the transactions affected each one of the accounts now. So the first thing that we're going to see is that there was a training expense for $300 as a debit. We just go to the training expense account, debit $300. Then we have cash $300, and that's going to be on the 3rd. So 1/3, $300. Then we have prepaid rent, debit $3,000, prepaid rent, debit $3,000, security deposit $2,000, debit, security deposit $2,000, debit, cash $5,000, 1/7 credit, 1/7 credit $5,000, office supplies $120, office supplies $120, cash $120, cash $120. So you're gonna go and just go about every single one of these accounts, and you're going to create a T account for that. If you don't see the T account here, you're going to create it. If it's already created, all you're going to do is you're going to add either a debit or a credit according to how it was recorded on the journal. Be always aware of the beginning balances. If you had a beginning balance, you should put that beginning balance on these accounts prior to starting to do some debits and credits. Some of you may have noticed that we have three things that have no value: accumulated depreciation, rent expense, and depreciation expense. The reason why these don't have any value is because what we're going to do is we're going to further in the exercises, we're going to go and put some amounts here when we do the worksheet, because these are accounts that most likely are going to be affected by the adjustments that we have. One, for the prepaid rent, and two, for the furniture, as we're going to depreciate it. So we are going to work on this in a few moments, but I wanted to go ahead and send out this example for you and make sure that you had all that information. If you have any questions, again, shoot me an email or comment in the link below as well.